turn to the external sector. Despite the challenging and turbulent global macroeconomic environment, India's current account deficit last year remained modest, much below the levels considered to be sustainable for emerging markets. During April to May this year, the current account recorded a surplus of $2.8 billion, primarily led by services trade and strong remittance receipts. In Q1, India's merchandise trade deficit widened to about $86 billion from about $69 billion in Q1 of last year. This is mainly driven by imports of crude oil, electronic goods, and gold. Going forward, moderation in global trade growth, surge in energy prices, and persistent trade policy uncertainties pose upside risks to India's current account deficit. On the other hand, implementation of the India-UK trade deal, along with many other recent agreements with major trading partners, healthy services exports, and buoyant inward remittances are expected to mitigate these risks. On the external financing side, gross FDI inflows were buoyant at $30.7 billion in the first quarter of this year. They are higher than $26.7 billion in the same period last year. This underscores the continued interest of global investors in India. Net FDI inflows also mainly driven by higher gross inflows and a slowdown in growth of outward FDI increased during the period. Moreover, FPI to India has seen a turnaround in June and July this year with net inflows of $7.1 billion. This is, of course, primarily driven by the debt segment and after registering net outflows during April and May of this year.